All right, today we're going to talk about something we all deal with, but maybe don't really think about. The price of money itself. We're diving into the pretty wild world of exchange rates.
So let me just ask you something right off the bat. A question you probably think has a really obvious answer. You hear it on the news all the time, right? A strong dollar. And that sounds good. I mean, strong is better than weak, obviously. But when it comes to economics, is it really that simple?
Well, as you can probably guess, the answer is, well, it's complicated. It's not a simple yes or no. The reality is actually way more interesting, full of this push and pull that has real-world consequences for every single one of us. So let's get into it.
Okay, so to really get a handle on what makes a currency valuable, we have to start at the source. We need to go to the place where its price is set, and that's the foreign exchange market.
What is that? Well, put simply, it's just the giant global marketplace where people trade currencies. You know, if you're a tourist swapping your dollars for euros for a trip, or you're some huge corporation paying a supplier on the other side of the world, guess what? You're a player in this market.
And the scale here, it is just absolutely mind-boggling. I mean, get this, we're talking about $6.6 trillion being traded every single day. Just to put that into perspective for you, that makes the foreign exchange market by far the biggest financial market on the entire planet. Now, in this absolutely enormous market, there is one undisputed king, the US dollar. It's involved in a staggering 88% of all trades. So why is that? Well, it's because it's the world's main reserve currency. It's what central banks around the globe hold on to. Plus, it's what's used to price huge commodities, like oil. The dollar is really the benchmark that everything else is measured against. So, who's actually trading all this cash? Well, it's a real mix of people. You've got companies buying and selling goods internationally, tourists like you and me grabbing cash for a vacation, and big-time investors moving money around the world. But honestly, the real heavy hitters? They're the banks and the big financial dealers who are trading absolutely massive amounts of money all the time. All right, this is where we get to the heart of our big question. Because here's the thing, whenever an exchange rate moves, it's not just some number changing on a computer screen. It actively creates real winners and real losers.
But first, let's just make sure we're on the same page with the lingo. When you hear that a currency is appreciating or strengthening, all that means is it can now buy more of another currency. Its buying power has gone up. And depreciating or weakening, you guessed it, it's the exact opposite. It buys less.
So here's a super simple way to picture it. Let's say the dollar strengthens. Suddenly, that trip to Paris you were planning just got cheaper. Score! That's a huge win for you. But what if you're an American company that sells, say, bicycles in Europe? Well, for you European customers, your bikes just got more expensive. That's a big problem for your business.
And this little chart really lays it all out. When the dollar gets stronger, who's happy? Well, the American tourist abroad for sure. And interestingly, a foreign company that sells its stuff in the US is also thrilled because the dollars they earn are now worth more when they take them back home. But American companies selling overseas or foreign tourists trying to visit the US, yeah, they're not so happy.
So what actually makes these currencies go up and down in the first place? Well, it all boils down to the most basic idea in all of economics, that good old seesaw of supply and demand.
When you strip it all down, an exchange rate is really just a price. Think about the US dollar versus the Mexican peso. The markets for these two are basically perfect mirror images of each other. If a bunch of people suddenly want to buy dollars with their pesos, the demand for dollars shoots up and its price, the exchange rate gets stronger. And that means, by definition, the peso has to get weaker. It's a zero-sum game.
Okay, but what's driving that supply and demand? Sure, things like interest rates and inflation play a part, but you know what the biggest driver is a lot of the time? It's just what investors expect is going to happen in the future. If everyone thinks the dollar is going to be stronger tomorrow, what do? They buy it today. And what does that do? It makes the dollar stronger. It's kind of a self-fulfilling prophecy.
And this right here is how fortunes are literally made and lost. Check this out. An investor who thinks the British pound is about to get stronger can take $24,000, change it into pounds. And if they're right and the pound strengthens just a little bit, they can change it back and walk away with over $25,000. A huge chunk of that $6.6 trillion we talked about, it's all driven by this exact kind of bet.
So, with this much money flying around, and with such massive consequences for entire economies, you're probably wondering, do governments ever get involved? And the answer is a big, resounding yes. They absolutely do.
And governments have a whole range of options. On one end of the spectrum, they can just let their currency float freely, let the market decide its value. On the complete other end, they can peg it or fix it to a specific value. And in some really extreme cases, they might even ditch their own currency altogether and just adopt someone else's, like the US dollar.
But why would they want to interfere with the market at all? Why not just let it be? Well, the number one reason is to prevent a total economic disaster. These huge, wild swings in a currency's value can be unbelievably destructive. So to stop that from happening, a country's central bank can jump right in, buying or selling massive amounts of currency to try and push the price in the direction they want it to go. This is especially true when their whole banking system is on the line.
Let me give you a really powerful, real-world example of this. Imagine a bank in Thailand. It borrows money in US dollars, but it lends that money out to locals in its own currency, the Thai baht. Now, as long as the exchange rate stays pretty stable, no problem. The bank makes a profit. But what happens if the baht suddenly gets a lot weaker, which is exactly what happened during the 1997 Asian financial crisis? All of a sudden, that bank is in massive trouble. The baht it gets back from its loans isn't worth nearly enough to pay back the original dollar loan, and that can lead straight to bankruptcy.
Okay, so we've looked at how this massive market works. We've seen who wins and who loses when currencies move, and we know why governments sometimes step in. I think it's time to circle all the way back to that question we started with and get a final verdict.
So, after all of that, let's ask it one more time. Is a strong dollar actually a good thing? And the answer is, it totally depends on who you are. Seriously, there is no one-size-fits-all answer. Your perspective completely changes depending on your role in the economy. For some people, a strong dollar is fantastic news. For others, it's a total disaster. It really is a classic double-edged sword.
And this quote really just nails it. A stronger currency isn't necessarily better, it's just different. You know, we love to stick labels on things, good or bad, but in economics, a stronger currency isn't really either of those things. It's just different. It comes with a whole different set of winners and losers. And that really leaves us with a much bigger, much tougher question to think about. Since we know that every little shift in an exchange rate is going to help some people and hurt others, who should our economic policies try to help? The companies selling things overseas or the companies buying things from overseas? The American tourist or the local business owner in another country? There are no easy answers here, just a never-ending series of trade-offs.